Hello, Daniel here from the Southwest Florida Real Estate Channel. I'm going to talk for a few minutes about rental. So I'm going to talk about it from a few different directions. One is being a renter and the other is having some rentals. So being a renter, you've got a few positives there. First of all, you're missing out when you rent property. You are missing out on tax deductions that a property owner gets. So for the most part, if you are renting the residence and then residing there, you don't get to claim that cost, that rental cost, as an income tax deduction. In other words, you don't get a benefit. You don't get to artificially lower your income taxes based on the rent that you pay. Now, there's an exception to that where if you're renting space and you go into commercial, like you're renting a business, or you're using part of the space that you're renting. Let's just say you're renting 1,000 square feet and you use 500 of those square feet to run a business, then you do get some deductions in that regard. So you miss out on a deduction. But a big distinction to be made here is that a lot of people get very confused when you start talking about income, expenses, investment, and liability, and people a lot of times mush those things all together and really don't know the difference. So for example, on Facebook the other day, one of my friends said that she invested in an entertainment center and that she was very excited about her investment. Or people buy a car and they say, I'm really happy, excited about the investment I made in the joy of driving or whatever. That's the exact opposite of an investment. So an expense is a one-time deduction. So it can be your own deduction out of your personal bank account. So don't think deduction means that it's a business. It's a one-time cost. An expense means a one-time cost, and then that's the end of it. So as far as your debits and credits, debits being bad, credits being good, it's a debit. It's a one-time debit. So when people say I've invested in my TV center, what they've really done is they've said I have an expense that I'm satisfied with because I got something I wanted, which is my entertainment or my TV space. So that's fine, but it's not an investment. And then you've got liabilities. Liabilities are things that are a guaranteed ongoing expense. So most people, when they say I'm going to invest in some real estate ownership, most of them are exactly wrong. What they're doing is they're buying a liability. A liability is something that has guaranteed long-term expenses. So a cash liability would be, I'm going to buy a piece of real estate and I'm going to move in. I'm going to move me and my family in. I'm not saying that you shouldn't do that. I'm saying it's a liability. And so you're going to have to pay taxes. You're going to have to pay maintenance. You're going to have to pay utilities. These are all expenses. And people get that crossed up with, an investment. They say, well, but I'm going to sell it for a profit later. That's fine, but that's not an investment. What an investment is then, so what's an expense, a one-time cost? What's a liability, something that you purchase or something that you acquire in some way that's got ongoing guaranteed costs against no income or against less income than those expenses. And then what you've got is an investment. So a real estate investment, really the only example of a real estate investment is you buy property and it makes you money, and it makes you more money than your expenses. So that would be buying a house, taking it and renting it out, and it cash flows. And when we say cash flows, what that means is that your income, your rental income, is more than your expenses after paying your taxes, your principal balance, the amount that you borrowed on the loan, the interest, and any required insurance like renter's insurance, homeowner's insurance, hazard insurance, or whatever. And so that's what you're missing out on with rental. When you rent somebody else's space, you are helping them, create an investment potentially. You might be paying $1,000 a month rent, and what they're doing is their expenses are $500 a month for all of their stuff, principal, interest, taxes, and insurance. And what they're doing is they're using the extra $500 to play life with it. They can do whatever they want to with it. And then the other thing that they get to do is at the end of the year they get to claim expenses. So what happens is if you are that quote unquote potential landlord, what you're doing is that income, you get to claim expenses against it. So your property taxes now, you get to claim that as an income tax deduction. If you hire a property manager, you get to claim that as an income tax deduction. So the other thing about it is some people hire themselves as a property manager. The way to do that is you create, in Florida, there's great corporate law related to taxes. You create an LLC. The way to create an LLC is to go to sunbiz.com. at sunbiz.com and do a name search, do a fictitious name search. And then what you can do is you can file articles. They call it articles of corporation if it's an S corp or a C corp. But if it's an LLC, they call it articles of organization because it's not really a corporation. But what you can do is, for example, sign these are employment independent and contractor employment forms. You sign a 1099, for example, a 1099 agreement with yourself as an independent contractor. You pay yourself property management expenses. So for this example, let's just say you got that $500 a month cash flow. And what you do is you need to hire a property manager and pay them $500 a month to manage your property. And so what you do then is you have that money paid. You sign basically an agreement with yourself, a 1099 form, and what you do is you pay yourself as a property manager, but you're not really paying yourself. You're paying an LLC that you set up. And so that does a couple of things for you. Number one, related to your property ownership, you get to claim that property manager expense. That's an expense against your income, and you do it the way that I said. You're not going to end up paying any income taxes at all on that property. You're getting rid of a lot of income taxes. And the other part of it is you get to take that cash that you made as an independent contractor to your 1099. Your 1099 miscellaneous is the best form. You get to keep all that money, and that's taxable generally at a 2% rate. No state income taxes in Florida. You got a 2% rate on the LLC, and there are ways to find expenses against that as well. So anyway, I don't expect that after just zipping through that real fast that you know how to do it, but I want you to get the gist. The gist is that if you're renting property, that's just fine. What's good about it is you've not purchased a liability. Okay, so the other thing about it, so you do have you've got expenses. What you've done is you've guaranteed 12 expenses. Okay, so but it's not a liability, meaning from the perspective of there's not other expenses that are going to occur. You've got somebody that you can call if the air breaks or if the electric breaks or something like that. So those are all positives. The negative, another positive is if the value goes down, that's not your problem, right? But on the negative side, now somebody else is acting as an investor, so to speak, assuming that your rental income provides them more income than